Hello to all traders joining me on this free live webinar brought to you by Orbex. My name is David Kinley, and today I'm going through money management and trading psychology. So in the last month, I've covered an introduction to Forex markets and CFDs, calculations, important calculations when trading Forex and stocks, CFDs, how to trade them, what to look out for. Now I want to turn my attention to money management and trading psychology. I've put these two together because managing your finances when you are getting in and out of trades has a lot to do with trading psychology and what it can bring with it. So without further ado, just like to say thank you very much once again for joining me. And any questions that you want to ask during the webinar, you can ask them live. I'll answer them so that we can really get into any examples you want to share. And I'll be sharing my personal examples as well. So as we go into the first slide, so managing your capital, what does it mean? So depending on your trading style, how much do you invest per trade? And this is either in a daily or weekly or quarterly or however you're trading yourself. So we've got an example here of a $10,000 balance. So how much should you invest? So what's a good amount of capital to invest from this 10,000? Is it 1%, 5%, 10%? And how will this risk affect your overall account? So let's just take a look at the quick example I've just put at the bottom of the screen. So $10,000 capital at 3% risk. So that means you're only risking $300 of that 10,000 of your equity or balance, whatever you want to call it. So $300, and then based on what your trading appetite is, how many trades that you want to open in a given day, week, or month, etc. It means you cannot lose more than $10 per trade if you're doing this scenario. So $300 that you've got to play with, that's how much you're willing to risk. And you want to do approximately about 30 trades in a month, let's say. It's a nice round figure, and also obviously usually 30 days in a calendar month, but obviously a little bit less for trading days. So you've got like 24, 25 days usually for trading. So this means you cannot lose it more than $10 per trade if you put the correct stop losses or take profits in place. So based on that small calculation there, you can get just a feel of managing your capital and what it can mean to your overall account, basically, because, you know, we don't want to just deposit funds and then lose them within a couple of days. You want to manage your risk, manage the capital, and that will be even better. So how much should you risk? How much should you put into a trade? So I've just given a round figure here. Is 5% too much? A lot of people say 1% to 2%, which is what a lot of traders and investors go on. They don't go on anything more than 1 or 2%. But let's just take another example of 5%. So risking a 5%, having a 5% risk on each trade and opening 5 trades at a time, for example, is 25% of the capital being at risk. So you probably would think this is a little bit too high. So 25% of your capital, that's a quarter. And if that obviously gets moved out of your account, if you do sustain losses, then 25% is very, very hard to recoup. And it's not uncommon when trading CFDs to see these 4 or 5 trades losing at the same time. This is because if you're trading some of the more popular Forex pairs, euro dollar, pound dollar, dollar yen, depending if you're buying or selling the dollar, you could be at risk of the market going in the opposite direction to your buy or sell, depending on if you're buying or selling the dollar, for example. And obviously your risk capital will be very, very exposed. So let's just take a look at things to take into account then. I'm going to go on with live examples as well. You know, I don't like to always keep PowerPoint presentations because it gets a little bit boring. I want to keep it moving. I'll show you on my MT4. I did a few trades today that's going to tie in with this behavioral trading psychology as well. So you let me know if I should have done the right or wrong thing. So things to take into account. So avoid trading during high volatile impact news, as the whipsaw effect could badly affect your account. Now, what's the whipsaw effect? Well, going to my MT4 account here, let's just take a look on, let's say, the euro dollar. I've got a nice example here of a whipsaw effect. So this is a minute by minute chart. And what we saw today in today's trading was basically this maneuver here. I'll just show you. So we moved down just over 10 pips, and this was in a couple of minutes. But within a couple of minutes after that, the price of the euro dollar went up by, let's just see, went up by over 30 pips. And this is just in about a 5-minute period. So based on that, this whipsaw effect can be leave you very, very exposed. And trading these high fundamental impact news events could really affect your account if you don't have the correct stop losses and take profits in place. However, even if you do have the correct stop losses and take profits in place, there is the chance that the price may gap. There could be a gap in the market and your stop loss or take profit could be missed, and it would take it at the next best available price in the market. So what do I mean by that? So basically, as we see here, what I'm trying to do is highlight this top of the candle here, not the wick, but just the top body. So as we've shot downwards and moved back upwards, it's roughly about a 10 pip move, very, very quick. And in this 10 pip move, if there is a high impact news event and you've got a stop loss here, then just because there is a full body screen happening, full body candle happening at the moment, it doesn't mean that the prices were filled at each tick here, each level. It could mean that the first price was here and then it went up to the next price and then back down, and in doing so has missed your pending order, which could be your take profit or your stop loss, and then in turn you could actually miss that. So, the whipsaw effect when you're trading high impact fundamental news events just basically means be careful with your account. Treat it like it's your baby, treat it like it's something very, very precious to you, because you don't want to miss anything in the market. So going back to my other point, apply protective stop loss and take profits. Very, very important. Never trade more than you can afford to lose. But how much capital to risk? Well, this depends on your risk appetite. In the previous example, we gave a 5% risk, and that seemed a little bit too much, because if you just want to open 5% on 5 trades, obviously that's going to be 25% of your capital being at risk. But if you were to lower it to 1% at 5 trades, then it becomes a different picture, 5% of your capital being at risk. So if you've got even $100 in your account or $1,000, then it's not really going to have too much of an effect on the account at all. So just moving on quickly to trading psychology. Now, there's been a lot of talk over the years since I've been in the industry about trading psychology and how it can help the investor, the trader, move away from this emotional mindset. So your emotions get involved and the mindset equals your decision making. So I've highlighted 6 feelings, let's say, that go into trading psychology, some of the most popular, and confidence, discipline, fear, hope, greed, and regret. So we'll take a look at these in more detail now. Because greed, for example, this means taking on too much risk. So we gave the example of 5% of your account being at risk. If you go up to 10%, let's say, is it too greedy? Are you being a bit too ambitious on the trades and thinking that possibly you can get more out of it than is possible in the market? Staying in a trade too long in the hope it will turn around, doubling down on a losing trade and being over leveraged. Now, this point number 2, staying in a trade too long in the hope it will turn around. I want to give you this example because I opened a trade earlier today on the Dow Jones. Now, I opened this trade because this was the weekend gap. Because of the tensions in Russia and Ukraine at the moment, there's been a lot of market activity over the weekend, and as the markets have opened, there's been very big gaps from Friday's close up until Monday morning's opening price. And because of that, a lot of opportunities have been in store. So this is the close price, let's say, for example, and then we've opened roughly about here, or it could have been a little bit less down. So I'm thinking, okay, we've gone down and now it's moving back upwards. Excuse me. And during the course of the day, I saw a little bit of resistance at this particular point. You see these false spikes here. Sorry, not false spikes, these spikes and these breakaways. Even here, we saw a little bit of an ascension. However, the prices fell back down. So I opened a sell order thinking it would go back down. However, we've now broken this line and we start to move higher and higher. At one point, I was in a loss of over $400. And my greed, my psychology thinks, no, I'm not going to close this trade. I'm not going to have this loss because I believe it's going to go down. Well, at the moment, it hasn't gone down. And in doing so, I've actually thought, well, you know, my greed for my trading psychology has stopped me from closing this trade earlier and taking less of a loss. Like now, for example, I'm at a loss at $212. Before, when it was up here, I was at a loss almost double that, almost over $400. So that's where your greed comes in. It's nothing to be ashamed about. It's part of the trading psychology and something to control. And in doing so, you get better as being a trader as well. So this is why staying in a trade too long and the hope it will turn around is making my trading day a little bit more stressful. In the first point, I also said taking on too much risk. What does that mean? Well, at the moment, I've got a balance of 1,590. My margin to open this micro lot of 0.10 is 335. So let's get the trusty calculator out. So basically, when you are trading on any symbol, just look at the specifications. I did touch on this in the last seminar. However, we'll go back on this again and again to make sure we're very comfortable with everything. So how do we get this margin? Well, it's the notional value, 33,549.75. And as you can see here, the margin percentage, it's 1%. So if we put that in a percentage, so we multiply 0.1%. So 335.497. So we rounded up to 335.50. However, at the moment, this amount, if we divide it by my balance and times it by 100 to make it in a percentage, I'm risking over 21% of my account on this one trade. And as you can see here, my margin level is getting dangerously close to margin call, which is 100%. And it's a territory that we don't want to go to because we don't want to get into this dilemma of what it could have been and when should I have closed my trade. So what I probably should have done is taken out a micro lot, 0.01. That would have been, that would have meant it would have been a lot less of a margin call, sorry, a margin level than what I'm at now. But anyway, needless to say, I wanted to keep this trade open to show you how greed can actually be included in the trading psychology. And the last bullet point here, being over leveraged. Now, what is over leveraged? Well, this means that if I opened 5 or 10 trades and I was winning quite significantly, it would mean that my account would let me open more and more trades despite my margin level, because my margin level would allow it. And why is that? Because my equity would be quite high. And being over leveraged is very, very risky, because if you have many, many trades open that normally you wouldn't be able to open because your account wouldn't allow it, it's only because you're in a lot of profit, then this could be very, very risky, because once the market turns against you a little bit, all of your trades could be stopped out. And it's a very, very lonely place to be. Excuse me, if that does happen. So moving on just to a few more examples. So we've covered greed. Now we want to go to fear. Now, these are all steps when you're doing trading. It comes with a lot of traders. And I'm just getting a live question now. 1 second. Okay, how do we avoid greed? Okay, well, avoiding greed is just basically controlling your emotions, getting confident. And if I just go back to the first couple of slides, confidence and discipline. These two are very, very important, because these basically try to cancel out a lot of the other points that I'm going to make shortly. So fear, hope, greed, and regret. These are all, when we get into this territory of hoping that the trade will turn around, being too greedy in placing our trade, fearing that it won't turn around or it will turn around, and then regretting the decision afterwards, then this is all a case of being a little bit too worried about the trade in general. So let's move on to fear now. So this is when positions move against traders, this poses a threat to the trading account. You're very, very worried about positions moving against you in the market. Before entering the market, the fear of loss stops the strike position and in turn loses the opportunity. And confidence diminishes naturally, coming out of trades too early or going in too late. However, fear can be useful because learning from past losses means not moving away from your trading plan. So let's take a look at the chart again. So I'm just going to give a random example. Let's give the Dow Jones that I was on today. So with that being said, how is fear giving me this scenario here of being down almost $200? Well, before entering the market, I entered the market a little bit late in my position. Sorry, a little bit too early. Sorry, I should have waited to see if this particular resistance zone here would be broken. Once it was broken quite significantly, and then the next candle, this is on a 30-minute chart, by the way, and then the next candle progressively moved up, then I should have put my sell position in, because it would have been a very nice position to be in, because we've got the next high here, which was the close on Friday. And this will be a very high resistance zone now, and which it has been. So now we're moving down. So my fear led me to open the trade a little bit too early. I was a little bit too trigger happy with my strike price. And in doing so, I've missed out on this nice move to the upside here. Now my confidence kind of went down a bit, because I'm thinking, okay, well, I've got to get out of this position somehow, but my greed factor has kept me in this position as well. So just keep that in mind. But as I said, fear can be useful, because learning from past losses means not moving away from your trading plan. If you've got a trading plan in sight and it's working for you, then do not move away from it, because it can be very, very useful. So in the future, for my next trade, if I see another big gap in the market, especially a weekend gap after the open on a Monday morning, then I'll be looking to see what the best opportunities are. And if I see a break at this particular resistance or support zone, whichever way it breaks up or down, then I'll be looking at these particular opportunities to make sure I'm fulfilling them. At the moment, as you can see, since I started the webinar, I was on $208 minus, and now it's coming down slowly. However, as I said, I could have been a lot more profitable if I just waited a bit longer and opened roughly at this zone here. So just a few things to take into consideration there. And next, hope and regret. So two very big psychological barriers, because hope comes with regret. And, we're seeing at the moment how it's going to play out in the market as well. So regret could influence you to enter trades at the wrong time. And this could mean, like I said, it all ties into the whole trading psychological bubble. I've regretted entering the trade too late on my Dow Jones. And then hope comes after regret, in the sense that the trader will make some sort of profit. So going back to our example here, we are looking at the moment that I'm regretting going into that trade too early, and I'm hoping that it will turn around. Now, let's just take a look at the other points. So hope is connected to pride. Some traders don't like to admit that they're wrong. And surely what goes up must come down, right? Or vice versa. Well, this is the hope. So I was checking the cable chart, pound dollar, today, just for this webinar, just to give you an example. Now with cable, for example, for most of the last couple of weeks, we've been in this choppy sideways channel for a while. We've had a couple of little false breaks out of it, but essentially we are doing a few tests to the upside and downside. However, now, as you can see here, the trade itself, if I enter the trade and I thought, I think it's going to bounce here, or even here at this very heavy resistant support of this double bottom that we saw just only a week ago, I would think that it's a good position to buy, in the hope that we're going to have a bounce around this area and start moving higher. Even if I had if it even broke a little bit to move up. But as you can see how far down cable fell, let's just take a look from this position to here, over 200 pips. So this is the hope that the trade will turn around for a greedy trader, or a trader that is very fearful that the trade is not going to turn around. And in doing so, look how much of a loss, if protective stop losses were not put in place, this is how much it probably would have fallen. And look how much of a risk the trader would have been taking in that respect. So with that being said, I just want to give a live example of the cable chart, pound dollar, to show that surely anything that goes down must come back up. As you can see, we have had a bit of a turnaround, but not as far as it's fallen. And if we go from here to here, you know, if we've fallen over 200 pips, we've only recovered 150 pips. And that's from this zone, never mind the actual channel that it's broken out of. So just a few things to keep in mind here. So hope comes with regret. And, you know, we are hoping that the price will turn around at some point here, you know, could be here or here or here or here. It hasn't done it, and now we're regretting because it's fallen so far, over 200 pips. And now we're regretting that the fact that we even opened the trade, first of all, and then obviously that we didn't close the trade when we saw the worry, especially going from probably around this area to this area, that it will keep collapsing lower. So this is a very important factor to take into consideration as we look into more trading psychologies. So with that being said, as I said, what goes up must come down, right? Or what goes down must come up. Well, not necessarily. And, you know, admitting that you are wrong in a trade it goes a long way when describing what kind of trader or investor you are, because it can really, really help you in the long run and really, really see what is going to keep on moving you forward and time again. So I just got another live question here. How do I diminish regret? Well, it's difficult to do in the beginning. We'll have to see, you have to see your own risk appetite, first of all, your own trading style, and don't be afraid to cut your losses. This is very, very important. You know, if the trader had this trade open here, or let's go back to my Dow 30 trade. If we had, if I had opened a little bit earlier and actually closed around here and taken a smaller loss, now my loss has gone to $100 because the market is moving lower. I'm hopeful now that the market will get to my entry point at least. Maybe I can break even. Will I break even in this scenario, or am I going to be greedy and think that the market is going to fall lower? And is that greed going to come back to haunt me? Am I going to get a bounce at this line? And is it going to start moving back up to test these recent highs that we saw today? Possibly. So getting back to the question, how to diminish regret? Well, try not to make sure you have no regret in the first place, because in doing so, you are affecting your whole trading plan, because the trading psychology is not something you want to mess with too much, especially if you are just starting out as well. So confidence and discipline. So discipline equals consistency, and consistency equals a more chance of successful trading. And then in turn, success equals more confidence. Of course, the more trades that you're winning with, the more confident you're going to be. You're not going to really worry too much if you've made 50% on your account, because you're in a profit already. That's going to give you more confidence. And even if you get a few losing trades, you're going to still feel confident, because you can still apply those protective measures and you can still have the trades that you want. So let's just look at a few things that I base my trading plan on a daily basis when I do trade, and even monthly and quarterly. So trust your trading plan. You know, if it's made for you, if it's made to measure for you, then stick with it. If, of course, it's not going your way after maybe 1 month, 2 months, 6 months, then you can change it. It's not a problem. But if you're comfortable in your own training plan, in your own skin, let's say, so to speak, then keep going with it. Lose the crowd noise. The crowd noise is basically when there is a big fundamental high impact news event in the market. Maybe it's best not to trade it. Maybe if your trading plan does not include this, don't trade it, because as I said, on the euro dollar example that we had a move to the downside. Just move this out of the way. We had a move to the downside of 10 to 12 pips. And then immediately afterwards, bang, 35 pips almost. And as you can see, very, very choppy on the euro dollar at the moment. I just gave this example because it was very, very V-shaped recovery there, a very, very V-shaped recover. And then bang, another 20 odd pips to the upside. So this is something that we can, you know, lose on the crowd noise, let's say. Use your initiative and avoid the obvious. So, you know, if you are trading any big news event or anything in general, avoid the obvious thing of going in when you're not comfortable in the market. And if there's an obvious downturn or upturn and you go against the market, don't break your own rules. Going back to point number one, trust your trading plan and don't be afraid to take risks and lose some positions. So these risks, like we said in the beginning, 1%, even less than 1%, maybe 2%, depending on your risk appetite. Don't be afraid to take a couple of risks that won't really damage your account too much. You can take these risks to test yourself, to test your trading psychology in the market, and however that's going to work for you as well, because it can be very, very good. And you can see what's going to happen there. So going back to putting in protective stop losses and take profits, I just want to take you to a gold trade that I did today. And I had gold open with the Dow Jones, but what I've done here is I applied a protective stop loss. So let's go to my gold chart. So what I saw on my gold chart today, I opened the chart in the morning and I saw this massive gap. So, you know, big weekend gap, roughly about $20, $25, very, very nice. So I've seen a nice opportunity there. And, you know, as the markets come down, I'm thinking, okay, it's bouncing back up now. So based on the morning lows that I've seen, I've opened the trade roughly at 1900, which is here, because I believe in the hope that my trade is going to start moving higher and start testing these morning lows. So I'll just zoom in a little bit so it's a little bit easier to see. And it worked out in the end because my trade started moving higher. However, I did see this whipsaw effect that we would start closing the gap that we made, which it has done. As you can see here, the gap was roughly about $20. And we've moved back down and covered that gap completely. Where it's going to go now, we might see another test to the upside, but I'm not interested in that. What I wanted to see was the fact that the trade is going to start moving higher. When it got over a certain level of 1910, it actually went up to 1915, 1917 in the end, sorry. And I put in a protective stop loss because my, let's say a little bit of my fear overcame my greed. I was worried that the candlesticks would start moving lower, gold would start collapsing slightly. So I wanted to put a protective stop loss in at 1910. So I was happy to take roughly about a $90 profit on this. And in doing so, I closed my account. So let's just get rid of these just to make it a little bit more clear. So with this example here of gold, I've gone into my trading psychology. I've gone with the hope that my trade, I'm going to enter my trade at the right time because I checked here when it was above 1900. I thought, right, it's going to start moving higher. I was very sure that it would. I was very confident that it was going to go higher. And as it did do, I hope that it kept on moving higher. But then I got a bit of fear, a bit of worry that it's going to start moving lower. So I put my protective stop loss in. It closed correctly and I made a nice profit and I don't have to live with a regret. The only regret that I could live with, I could have, is if I was very, very greedy as a trader and thought, okay, well, I could have left it to 1915, let's say, stop loss. And then, you know, as the market went to 1917, I would have got a little bit more of a profit. These are the things that you have to just, a lot of traders when they're trading, and the psychology is just to keep in mind what kind of things you're trading with and the psychology that comes along with it. So with that being said, I just wanted to go to the next slide, which is noise trading. Now, noise trading comes very high with trading psychology, as there are a lot of things to take into account. So what is noise trading in general? Well, it's someone who trades based on rumors. So rumors being, okay, well, somebody's told me that oil is going to go up at the moment or gold is going to go down. So, oh yeah, they'll buy and sell just based on rumors and not facts. So they do not take into account fundamental or technical analysis as well. Without noise traders, the market could be more efficient and expressive. The most important element of noise trading is volatility. The greater the volatility, the more it will attract noise traders in general. So with that being said, let's just take a look back on the chart for gold. So as you can see here, we had this huge false spike in gold today. So what probably happened when the market did open, we saw a lot of buying pressure in the market, probably from noise traders because they thought gold would start moving higher. Gold has been moving higher in the near term due to the ongoing conflict. I just put it on a 4-hour chart to show you. Due to the ongoing conflict with Russia and Ukraine, it's a safe haven asset that a lot of traders flock to when there is conflicts in the world or something like a pandemic as well. So because of this, we saw it spike up to 1975 roughly, and then it's fallen back down quite significantly in the space of a few days. This is because of, as I said, the ongoing tensions, a lot of the news coming out of the Ukraine-Russia crisis. But because of this, when the market did open, look at this big false break. Now, false break is when we see a spike, a very heavy wick on the candle, very, very long. And we've gone through a section where we probably shouldn't have normally. So because of this, as you can see, these are the full body candles that are hitting this resistance zone here. And this break here seems to be a false one because we've gone through a level where we wouldn't normally. So upon the market open, there's been a lot of buying pressure and there's been a big whipsaw effect because as you can see, there's a very small body on the candlestick. And because of this, it's moved a little bit higher out of the boundary. So just one moment. Okay, I'm just clearing my throat just to go to the next section. So this is basically what a lot of noise traders go into. And you can see these spikes quite significantly wherever you go. Let's check the dollar yen, for example. As you can see here, I'll just zoom it in a little bit so it's a little bit easy to see. There's a lot of consolidation around this area here as we go into today's trading. As you can see, very, very small candlesticks consolidating, bouncing off each other. But then you've got this false break to the upside here, which means we're moving higher and it's looking like it's very, very high buying pressure, noise trading, probably on some news events or you know, buying the rumor. And then we've come straight back down again because there's no real fault, there's no real reason to have that buying pressure. And then bang, we've gone down and the bears have come in. So this is basically noise trading, and it has a lot to do with trading psychology. So what are the risks of noise trading? Well, when short-term and or emotional investors overbuy or oversell an instrument, excuse me, prices are driven past the levels where they should normally be and leads to false breaks in the market. So like I said, we've been driven to a level where we probably shouldn't have gone normally, but because of noise trading and a lot of buyers in the market at the time, we've gone up to nearly 1930, and that level was last seen last week. So because of that, now the price has been heavily resistant on the 1917 area, and now we're consolidating it into this level here. So when you do see false breaks in the market, let's just take it back to the hourly chart so you can see a few more false breaks. When you see these false spikes, they're tests in the market, which basically means that the noise traders are just going in and out. There's big buying or selling pressure for a few moments, and then we have a whipsaw effect and the price goes back to where it was before. So that's just something to take into consideration at the moment. Just got another live question here. How do we identify easy false breaks? Well, as I said, depending on what chart you're using, if it's hourly, if you go on a daily chart, as you can see here, very, very big false break on the daily chart for gold. A little bit less identifiable on the daily charts, a little bit easier probably on the 30-minute charts or 15-minute charts. As you can see, better false breaks here. If we look on the US index as well, I was looking on the US index earlier because this is something that is a very good example when we're looking at trading psychology as well. We see the reversal on a lot of the noise trading. So let me just go back to the presentation just to give you what are the advantages. So prices are likely to settle back to their origins. Retracements are usually common, so the market becomes slightly predictable. So this is a very good example. I've got the US index open. Let me just check my trade to see how I'm doing. Okay, so now, as you can see, just going back to this, I'm worried that the price of the Dow is going to start moving higher again. And my greed is telling me I'm not wrong in this trade. I'm very confident at the moment that the price will start moving higher. However, my greed is getting the better of me, and I'm not putting any stop loss or take profit in, as you can see, because I think I'm going to turn this around, and my trade is going to actually get into a profit at some point. It's going to go back down to these levels here. So just wanted to add that in before we go into the next basis. So as I said, US index, 30 minutes. So this is how trading psychology is working with retracements as well, and noise trading. So as you can see from the open, we've had this large gap to the upside. And even though prices went higher, when prices started falling, and especially fell past the morning open price, there was a very, very good chance that the candles will start moving and fully retrace the gap. Now I'm expecting it to possibly start testing this area at some point. However, if you see this nice trend to the downside, you can see that it was a very predictable move in the market. We've, moved past the first price of the trading week and the trading day as well, and now we're moving lower. So with noise trading, this could be a lot of selling pressure. It could be the fact that people are in the market knowing that this is going to start falling down and start having a bit of a collapse. And in turn, we started moving down. So a lot of traders now are very confident that the market will keep moving lower to retrace the whole gap and start moving. So basically, if I had been on this trade, I would have entered it at 97.09 or possibly 97, nice psychological level. I would have expected the market to keep on going down. That's my confidence. That's my discipline. Now, the fear, if I had an open trade, would be that, is it going to hit this 96.50 area and cover the whole gap? Because that's my hope as well. And then my greed is telling me, keep a trade open because it's definitely going to hit this price. And if it doesn't, and it starts moving higher and I lose a lot of money, then that's my regret. I'm regretting that I kept this trade open and it's kept on moving lower. So this is how you can tie all this trading psychology in one. And that's how it can be even better for you if you keep this trading psychology in mind as well. So like I said, just a quick recap. So noise trading, someone who trades based on rumors, not taking into account fundamental or technical analysis at all. But as I said, without noise traders, the market will be a little bit more balanced because you won't have many false spikes in the market and a lot of misdirection as well. And just look at volatility as well, because as the volatility starts going a bit crazy, the more it will attract noise traders as well. And as I said before, what are the risks? This false break in the market is probably one of the biggest risks, as prices are driven past levels where they should normally be or shouldn't normally be, really. As I said, if we go back to the chart, I wanted to touch upon this stock as well, Activision. It was recently bought by Microsoft. And because of that, we had quite a massive jump in stock price. And now what a lot of traders did for the noise was the fact that they thought it would start covering the gap. So there was a little bit of a sell-off here, like I'll just show you now. So because that sell-off happened, there was heavy selling pressure in the market because bears were in the market. However, once the stock fell as low as it was going to, it didn't retrace the gap. Bears exited the market, meaning the noise traders moved on to another stock that they could probably start looking at. They were disinterested in this, and now we saw some heavy consolidation. And as you can see, prices have not really moved quite significantly since well, about almost a month now. So this is a good example of noise trading. We've had a jump in the market based on the rumor that Microsoft were going to buy this company, Activision Blizzard. Then when the move went in, we saw this huge jump in the market, almost $20 move up, $25 move up. And then, as you can see, the noise traders did calm down on the buy side. Prices started moving flat, lower, and now we've had this kind of flat consolidation, very, very flat, nothing much to talk about there. And Activision Blizzard just becomes another stock that noise traders had a look at, decided that they didn't really want to get too involved, and then they've moved away. So it's just a case of making sure that if there is a big move in the market, if there's a big acquisition on stocks as well, then this could be a very, very significant time when noise traders enter the market as well. So something to keep an eye out for there. Something very, very important as well. And so how to develop and improve your trading psychology yourself? Well, don't go into a trade without being fully committed. Get in the right mindset so you can get that strike price quite significantly. Make sure you are knowledgeable before entering. Remind yourself that it's not a demo account, but a real account, and practice, practice, practice. So point number 2, make sure you're knowledgeable before entering. Like I said before, with Activision Blizzard, it was a very, very big, knowledgeable move in the market that Microsoft were purchasing the company. It was the biggest tech acquisition purchase, ever at $70 billion. So naturally, Activision Blizzard's share price would start moving higher, and it was very, very predictable. So that's what being knowledgeable about entering the trade is. If we had the rumor that Activision Blizzard was going to get purchased by Microsoft roughly at the beginning of the year, roughly about here, on the 10th of January, just look at what the opportunity is in the market there and seeing what could be involved. And if I take you back to gold as well, if we go way, way back, go to weekly charts, we're seeing gold at the moment. When the pandemic hit, obviously, as I said, gold is a bit of a safe haven for a lot of traders. We saw this monumental rise in gold, over $500 in notional value movement to the upside. And this is basically being knowledgeable. We knew that gold would be a lot of people's favorite choice to move to during this time. And as you can see here, when the first wave kind of started, when the first wave was just dying out in the summertime, we saw gold prices move downwards. And then the second wave came, and then we had the licensing in November 2020, the first license and regulation of the Pfizer and AstraZeneca vaccinations. As you can see, a big, big sell-off in gold because a lot of traders moved away from this safe haven because the world was kind of getting back to normal. And then guess what? We had the second wave of the virus, the pandemic, just after the new year. And again, this moved prices higher. And then, as you can see, the world started getting a little bit back to normal. And then there's been a steady upstream. And then, as you can see here, due to the conflict in Russia and Ukraine, we've had another big move to the upside. So just remember, with gold, it's very, very easy to trade if you're knowledgeable about it. If there's big events going on in the world, pandemics, unfortunately, conflicts between countries, it is very, very easy to make sure you're in the right mindset there. Same with oil as well. UK oil hit a 7-year high recently, moving over $100 a barrel, $105 now. And again, it is the fact that there is this conflict. So naturally, oil is going to move higher. So being knowledgeable about a certain instrument or certain asset will help you in the long run as well. Because it is very, very important to be knowledgeable about what you're trading on. It's stocks, and other assets as well. It's very, very important. Remind yourself that it's not a demo account, but a real account. So any trade that you put in, it's your real funds. It's not a demonstration account. It's a real account. So with me, for example, I probably wouldn't have opened a 0.10 trade on the Dow if this wasn't a demo account. I wanted to show you how trading psychology isn't affecting my trade. And obviously with my gold trade as well that I did today, I did one good trade without regretting, without hoping. I did it based on the fact that I was knowledgeable, thinking that the price of gold would go higher. But for the Dow Jones, again, this was a little bit of a guess, thinking that it would break a certain level and start moving lower, at least to these lower ends here. So the trading psychology led me to believe that this trade is still good. I mean, I went down to $90, roughly about $85 to $90 minus. I thought to myself, I could take the loss here because, you know, $90 on this would leave me at 1,500 round, pretty much what I started my demo account with, $1,500. However, my greed got the better of me. I'm thinking, leave this trade open a little bit longer. But as you can see here, now I've moved up to 120, well, almost $130. And it doesn't look like now I'm going to see any big moves in the market. Do I hold this position overnight? Do I close it? What's going to happen overnight? Obviously, I'm not going to be awake the whole night. So do I close the trade, or do I put protective stop loss or take profit measures in? And what will be the outcome and circumstances as well? So this is all going down to the trading psychology. And the last, as I said, the last bullet point was practice, practice, practice. Just make sure that you're comfortable with everything that you do in regards to trading psychology. And let's just take a quick look back at the 6 steps that I always look at, just to have a recap. So confidence, you know, when you're winning, confidence is sky high. That comes with discipline, though. You have to be very disciplined when trading to make sure you're making the right decisions. But even if you make the wrong decisions and you slip into a loss, like I'm doing on my Dow Jones trade, to stop the trade, take the loss, and move on to the next trade. With this trade that I have open at the moment, you know, if I am in a minus of $100 or $90, I'm not risking too much on the account. However, it could turn quite significantly around. As you can see here, the Dow is moving lower now. I'm less minus, but I'm hoping that it will start moving lower and it will be better in the long term. However, my greed is getting the better of me currently. So let's see how that plays out in the next few minutes. So just to recap again, fear as well, hope, greed, and regret. These all come together as one package. You know, you're hopeful, then you start getting worried, you're fearing, but you might get greedy to leave, to stay in the trade, and then you're regretting staying in the trade as well. So as I said, greed, just to recap the presentation as we, in closing. So we're taking on too much risk, staying in a trade too long in the hope it will turn around, doubling down on a losing trade, being over leveraged. We did touch on doubling down. It just basically means that you're opening another trade in the same direction, thinking that it will still go in your favor. However, obviously doubling down means opening another, being exposed more in the market. And this will obviously increase your risk as well. Fear, when positions move against traders, this poses a threat to the trading account. Before entering the market, the fear of stop losses, stops the strike position, and in turn loses the opportunity. Confidence diminishes, coming out of trades too early or going in too late. And then, but fear can be useful in this kind of scenario as well, because we're just looking to see how we can learn from our mistakes and stick to a trading plan that can be very, very useful for us. Hope and regret. Regret could influence you to enter trades at the wrong time, which I did. Very, very good example on my Dow Jones trade. Hope comes after regret in the sense that the trader will make some sort of profit Hope is connected to pride. Some traders don't like to admit they're wrong. What goes up must come down, right? Well, not necessarily, as we saw in the cable, the pound dollar example. As you can see here, what went down certainly did not come up. And a lot of, if there wasn't any stop loss or take profit measures applied here, then there would be a very, very significant heavy loss. And then we'll, it would have been very, very detrimental in that respect. So it all ties into confidence and discipline. These are the key areas that you want to focus on to try and become that more successful trader. And if you get these two, if you get discipline under your belt, if you get it acknowledged, then the confidence will come along with it. So discipline, as I said, is equaling consistency in a way, and then consistency is more chance of successful trading. And then the success is more confidence as well. So trust your training plan, lose the crowd noise, use your initiative, avoid the obvious, don't break your own rules, and don't be afraid to take those small risks and lose some positions. It won't be too detrimental to your account if you take some risks along with that as well. Look out for noise trading. As I said, gave a couple of examples on the gold, on the US index as well. Noise trading, false breaks, very, very significant. Prices are driven past the levels where they should normally be. If you see these big wicks of the candlesticks like we had in gold, if you see these big spikes and it's a big retracement, just know that it's probably not a level that you want to really start looking at. It's most probably the full-bodied candlesticks or the shorter wicks that are really have more meaning in the market. This big false spike here doesn't really give us a signal or direction for support or resistance. So just be careful with that, as noise trading can be very, very significant in your in your trading psychology and your trading plan. However, there are advantages. As we've said, the price is likely to settle back to origins, and retracements are usually common in the market, and it becomes slightly predictable. And as you can see here, very, very predictable market. As you can see here with the US index, we have, I'll just zoom it in so it's a little bit easy to see. So now we've had this like bounce, another bounce, another bounce, and now we're going up. And now it looks like the market is coming back down. So I'm expecting a move back down to here. So, this is what I would be expecting to cover the weekend gap. So just something to look out for, as well, as trading can sometimes be a little bit predictable in that sense. And now going back to my Dow trade, now I'm getting a bit worried that my Dow position is going to start moving higher to these levels, and I'm going to go back into a minus 400 deficit, and my margin level will get increasingly close to the 100% margin call, and hopefully not close to the 20% stop out. However, it could happen. So I'll keep an eye on that. If you would like to take a note of this trade that I have at the moment, just to see where it ends up. So on the next webinar, we can see how my greed has overcome me on my trading psychology, and I didn't put the correct stop losses in. So that's a very, very, very nice example there of how the greed in the trading psychology can affect trades as well. And just lastly, how to develop and improve your trading psychology. So as I said, be fully committed, get in the right frame of mind, make sure you're knowledgeable before entering the trade. Remind yourself that it's real funds, not a demo account. This could be very, very significant, the way you think of things, and then keep practicing because it's very, very good at the moment. I've just had another question about opening a demo account. Yeah, visit our website, orbex.com, and it's a very, very easy step procedure to open a demo account. And if you need any assistance, our team is very dedicated to assist you. And also, if you would like any other anything else to be spoken about in the webinars, I'm going to be repeating the same webinars for next month, which is, so starting next Monday, we go back to beginning in Forex, how to trade, how to be a successful trader when you're beginning in Forex, introduction to FX markets. And then we're going back to important calculations in Forex. Then after that is the trading stocks, CFDs, and then finally going back to this webinar, money management and trading psychology. So with that being said, I'd like to thank you very much for joining me on this webinar. Any questions, I'll be online for as long as you want me to be. I've got a few questions to answer as well, getting back to a few people. So please feel free to ask me any questions you want. I'll be online for a while. And, you know, also feel free to share any subjects that you'd like covered on these webinars, as we are very, very open to going through any subject based on CFDs, based on trading, based on psychology as well. And as we go into the next month's webinars, I'll have a lot more information and examples to present to you, because as we go on to this journey with the webinars, we're going to get a lot more scope, a lot more interaction with our clients and potential clients as well. So anything that you want to have sent to you, or any interaction with myself, you can ask one of our support team at orbex.com. Feel free to log on and you'll be able to interact with the next webinars as well, and we'll see what's happening. I've had a couple of questions. Next time, touch on liquidity. No problem at all. Liquidity was it will be touched upon on the beginner's guide to introduction to FX markets, where liquidity will be mentioned. So that's going to be for next Monday. I'll be able to go through liquidity and volatility as we as you look at the candlesticks to see what are the best, or what sessions of the market or of the day, let's say, do we have more liquidity. So the early Asian and Australian sessions, we don't have much liquidity because there's not many buyers in the not many traders in the market. But as the European and American session opens, then there's a lot more liquidity in the market, a lot more pricing in the market as well. So we'll see, you can see that as well. And so yeah, any questions, feel free. Feel free to let me know. And thank you once again for being part of this webinar. As I said, any questions, feel free to express them on the chat, or you can visit our blog at orbex.com to speak to our live support team, who will pass on any messages after this webinar if you want me to cover them as well. So once again, thank you very much. As I said, I'll be online for a while, so feel free to ask me any questions. And until then, take care, God bless, and we'll speak again next Monday. Bye for now.